Happy Friday, everybody. Welcome to another Real Assets Weekly. Today is our 11th episode. Today is Friday. It's July 28th, 2023. With me is Jimmy Wang, our man in real estate, former REIT buy-sider, now in Portland, Oregon, and patching in today. And then down in the Eagle Ford, our man in the energy patch, Ryan Cobb, also known as Pescadero Land Management. He's a landman down in the Eagle Ford. And he's here to talk to us. We're just gonna have a little conversation, shoot the breeze on real assets. You got to start with some macro stuff. We got to talk about kind of what's going on FOMC, BOJ, central banks. And but before we get into any macro stuff, any finance related, let's start with kind of what brought us together, right? Which is Fintwit. And I think we have to start with the 600-pound gorilla in the room, which is, where are we going to hang out, guys? We were comfortably on Fintwit for a long time. And then if you, it's the logo at least, I mean, we're still twitter.com, but the logo is changed to x.com. There was a brief scare with Mark Zuckerberg taking over the whole ecosystem. And then now it looks like, now the name is x.com. So, welcome, guys. Happy Friday.
Happy Friday, Gerald.
Happy Friday, guys.
Yeah, great to have you on the show. I got another statistic I'm just going to pull out of my ass, I guess.
Yeah.
You hear something about like most podcasts and most recordings, they give up. Like they don't even make it to 10 episodes. So
yeah.
We crossed the Rubicon, right?
We made it.
11, yeah. 100. We're going to make this happen, right? Here we are.
Yeah. Sponsor us.
Great.
Inquiries.
Excited to you guys,
Yeah. That's right. No, I love it. That's it's a great place to start. And yeah, I know it is, getting out in what Fintwit created. Look at these guys on these spaces all day, these giant spaces. Mario, you've got the stock market news, stock talk weekly, Gavin. These guys are making crazy money. Just peddling like whatever, man. Like it is not. And yeah, I mean, I think the whole they've created a quite the content ecosystem. But what do you think, Jimmy? I know you follow this close. I don't know, or I know you follow it to some extent. Do you think that did you make a Threads account?
I made an account for one day. I made a shit post in response to something I saw. My wife promptly was pissed off and asked me to remove that meme. And then I and many other people quickly rediscovered why we don't use Threads and we don't use
because your wife hasn't found the burner yet. That's why.
Things like Facebook or Instagram for that type of humor, right? It's the real beauty of Twitter, of the Fintwit community, and I think we might have talked about this before. And this has happened in the last couple of years. But the idea that these organic discussions, whether they're fundamental analysis, whether they're technical analysis around different common investments, where there's a semblance of anonymity, right? The minute Bill Ackman comes in and says something, in some ways it becomes a popularity contest, but the beauty and the organic growth of the platform is just so many people having awesome ideas, things being hashed out, right? Or even just half full formed thoughts. But like this has been a platform where a lot of communities, but especially the investing community, can really come together and hash. You have to have that full discussion. And I don't think there's any other platform for it. Like people are not, when you're on LinkedIn and you've got compliance breathing down your back, you're not you. When you're on Instagram and you're getting bombarded with ads and everything you see is being influenced because your friends either don't post or they just post family pictures, that doesn't help engagement, right? Mark Zuckerberg knew that a long time ago. So we had this weird, these social media platforms, like what is the benefit to the user of being on Threads? I don't know. The value proposition for me is not there, but the fact that we're still pulling up Twitter to refer to our material
Yeah.
today, I mean, it shows you first and
Yeah.
foremost the value of the platform.
Right when I saw the fact that you need that link it to an existing IG account, I really was skeptical that Fintwit as a community would survive the transition. Or would it make
100%.
any sort of like exodus to like all these accounts are anonymous. You're not going to link it to an Instagram. You got to make a new. Ryan, I know you just moved,
Yep.
probably just getting settled into your new situation there. You just got back on Twitter, so kind of doubting you spent a lot of time on Threads, but did you look it up or did you look at it?
Oh, yeah. So I have a sort of mixed feelings about my use of social media. I've got a legacy Facebook account, and it serves purposes. I keep up with people I've met along the way. 15 plus years. But I try to limit my Facebook stuff to mostly family oriented. Whatever. And then I've got an Instagram account, whereas I'm almost like uh, it's almost like an alter ego or something. It's filled up with all my hobbies, and I grew up as a competitive surfer, and I've been a big fisherman and hunter, and just kind of a lot of these outdoor lifestyle things. And at least on Instagram, everybody is trying to kind of have this popularity contest, especially within those sort of niches, and a lot of like your sponsors, like my surfing sponsors, demanded that I do X amount of Instagram posts and blah blah blah. And that really just burnt me out. And so I now just sponsor myself because I'm about to be 40. And a 40-year-old surfer in Texas is not going to sell a bunch of t-shirts somewhere, so there's really not any mutual benefit for me there. I've found Instagram, I don't have the type of engagement for this, and so there was this kind of hole in my own personal need to kind of have that that what do you want to call it, like the super ego, right? Like most of my friends that know me as a surfer or whatever, they have no clue that I do this on my own, or that I've been involved in financial markets, or that I've been writing on Seeking Alpha. And I took a break from a lot of that, and it just started kind of getting to me like, well, how can I express these things I do that are not just, hey, look at me catch a fish or something like that? Because I knew I had certain things to offer. And kind of like Jimmy said, I have a kind of a sardonic way of communicating that message, and it's not always well received. And I have been known to shit post or needle people a little bit. And it is kind of nice to have the anonymity that comes alongside Twitter and the ability to have that sort of discourse, because it's not my goal to go out there and offend anybody, but it is to challenge people's opinion, or hopefully, be gracious enough to accept criticism of my own, material I put out there. And, Twitter is definitely kind of serves that purpose for me. And I do kind of regret taking a break from it, because it's very hard to build up much of a following, and I'm still not tweeting like I should. But it's a good way to, especially with something like Swami, it's a really good way to continuously kind of put information out there that feeds into the bigger ideas, or kick around trading ideas, or sort of fill in the gaps between the bigger picture stuff that we're trying to do, like with these Real Assets Weekly, or even providing our subscribers with stuff like that. So it is an ecosystem. And whether you like it or not, in 2023 and beyond, like, we're all connected through these social media platforms. And I think it's something that unless you want to be a hermit living in the woods, I mean, there's times I want to do that, but
Think about it.
going to be very hard to advance your professional career without some sort of presence.
Absolutely. And I think that's so well said. And I think that the building a small niche audience on Twitter, it's changed my life, and that's how I met you guys. And I consider both you guys friends, actually, which, I've never met either of you in real life, but I consider you both friends. And I think that that's from this Fintwit community specifically. And that's something I've always, well, I shouldn't say always, but it's something I've lately really come to appreciate. Quickly, before we leave the Twitter thing, and then let's roll, I did want to just point this out or I thought this was interesting. Just quickly throw it out there, just since we're on the subject. Here it is. The things you don't read on Twitter. This is the Asian stocks. This guy's got a good Substack, highly followed, Michael Fritzell, and focuses mostly on Asian stocks. But I thought this was interesting. I'll read it out loud for any of our just to be nice to people that are listening, doing the dishes or whatever you're doing right now. The Twitter rebrand, this is from Data Driven MD. The Twitter rebrand reeks of legal maneuvering meant to keep the company's most valuable asset, its brand, out of the fray. Rebranding affords Elon the ability to transfer Twitter brand assets to a shell company before X files for bankruptcy. The maneuver safeguards the brand from creditors and protects his ability to sell the brand without requiring the court's permission or reuse the brand when X emerges from bankruptcy. And so I'll open that to the floor. Let's go into some macro stuff. You guys, anyway, so that's interesting, right? Like, it is
interesting.
I hadn't heard about this. I know they still have the cash burn issue, right? They're still not quite profitable. They're burning cash. I don't know. I'm typically light on this. I do think as a user, I like the gradual transition from Twitter to X, whatever we'll be texting, sexting, Xing, whatever that is. Right? I've seen some great X video memes, right? All the good stuff.
No, I love it. So
DMX is DMX going to take over the brand?
Oh, that would be big. Probably not. Probably not. Based on recent events.
He barks like a dog when you click on the website.
With Elon Musk, all things are possible. That's one thing we learned. Look at this.
I just want to tie the thread quickly before we move on to the next topic.
Go ahead.
We talked about all these financial influencers on Twitter, the growth of the Fintwit as a platform. And Ryan, you're just saying how about building your brand on these different platforms, right? How you use these different platforms. I think the irony is not lost on any of us that in the financial profession, with all the compliance and the legacy rules and restrictions, that like none of this is legal or kosher. The people that are shilling their things are not licensed at all. Like the minute you get any of your licenses, you basically have a gag order. And I think the biggest challenge for anyone involved in the financial industry, especially as a professional, is the world is shifting, the world is evolving. Things are getting disintermediated, right? Whether we like them or not, there is a flow of ideas. There's a flow of capital to these new business models and these new different ways of value accruing to the producer. So there's a bit of a dichotomy there, where I think for a lot of legacy financial guys like myself, we're straddling this line where there's a lot of things we can do. There's a lot of things we hence the anonymity, but at the same time, we're not naive, right? We follow where the market is going and we see where this industry is going. And I think there is an incredible value to be on here, whether it's marketing or not, to be part of this ecosystem.
No, I totally agree with that.
Yeah, that's something that I really hadn't considered, but that's very well said, Jimmy. Thanks for adding that.
Let's tie this all together here. So this is year-to-date performance, S&P 500. One thing you may notice here is a bunch of big throbbing green boxes. These are percentage returns year-to-date. Tesla plus 120, Nvidia plus 220, Google plus 50, Apple plus, this hopefully is not new information to anybody watching the show. Pfizer minus 30, Johnson and Johnson, who cares about it? 60 years of increasing dividends, -1. ExxonMobil reporting earnings this morning, -6. So there's this value to growth rotation that's been violent. And one explanation that has made sense to me, or one partial explanation. Obviously, these are super multifactorial complex systems, but one explanation that's really been interesting to me is Weston Nakamura, and Weston has talked about this flow through between some of what's going on in Japan. Weston's based in Tokyo. He works for Blockworks Macro, former Real Vision guy, and he's talking about, and basically the gist is, if you look at USD JPY and you look at let's look at this really quick. So USD JPY, and let's add, that's the US 10-year, and if you add USD JPY to the chart, you'll see what's that meme? It's like they're the same chart, or whatever the meme is. It's like they're the same thing. That's basically the gist. And I can line these up, but essentially, he breaks it down in that there's a BOJ, or excuse me, a Ministry of Finance. I'm paper or I'm fingernail deep on this stuff. Jimmy can go deeper. So I believe so. I'd like to hear what he thinks about this, but just to tease it up a little bit, within an hours of the Ministry of Finance intervening when USD JPY hit 150 or was coming up on 150 in late October, that's when the 10-year US 10-year Treasury topped, like it topped it. And that also was the bottom for the NASDAQ, right? And so, and then, one other sentence on that is like, there's this blob of Japanese capital that since interest rates are so low, flows around the world and has these outsized impacts on asset prices. Weston, I would have never known, any of these tie-ins had it not been for some of Weston's thread. So I think he's a great follow. I'm not going to go through this thread because it's pretty complex, but I do think it's a great thread. Jimmy, I know you've been paying attention to this. What are your thoughts on the latest moves? Because overnight there was, I'll say one more sentence. I've personally been punting around little USD JPY. I've got a bunch of like everybody, I've got some duration sensitivity in my pile of assets, right? In my wad of capital. And so I was looking at USD JPY as a way to kind of play higher rates and maybe it was trading well for me for a while. Then the last couple, and then it's like in the middle of the night, boom, you just get wiped out. As Weston's been mentioning, Governor Ueda is taking heads, right? Like when volumes are low, he'll just, they will slam down USD JPY. So enough, Turtle. Jimmy, what do you think about all this?
Yeah, thanks for leading me into this. I think, like some of the other topics we've discussed, this is very complex, multifactorial. So I think, whatever I say is also just scratching the surface, and there's a lot of other, complementary factors, there's contradictory factors that support everything. But, if you recall, the BOJ held a multi-decade policy of keeping their risk-free rate, the 10-year, and they're basically their fixed income, all these controls at the zero bound. And people were incredulous. They were skeptical. They didn't believe it. People try to carry trade the yen and deploy elsewhere into other countries, right? People try to short the yen, and they would get burned time and time again. But when the first instance of this yield control happened a couple of years ago, right, there was a big news. It went from 0 to 25 basis points. And then it felt like there was a big regime change when that happened. This news doesn't surprise me. I think this is a continuation for people, especially in real estate, where you have longer duration investing horizons and just thought processes around capital allocation, around monetary policy. This is there's a lot of ramifications, and I'm sure there's a lot of reasons why they had to do this, right? It's no surprise that despite the internal deflationary dynamics in the country, that with all the money printing that's happened around the world, with the yen weakness, particularly vis-a-vis the dollar, as you mentioned, the real people who are screwed are older Japanese people, which there are many that are on a fixed income. When their currency depreciates 33% against a major currency basket where they're importing a lot of their goods, where there's a lot of stuff, like that hurts the people. I haven't seen some of the domestic rotations, but my initial take, and judging by the market reaction, was that this was quite bullish for Japanese equities, that there is some acceleration of growth, that inflation is also on the margin being tamed. But as far as the sectors that I've covered historically, let's say real estate, where they've really been a bond proxy, this is terrible news for real estate. And frankly, it's a continuation of that process, where coming off the zero bound for so many years, both at the retail level and at the institutional level, there was a lot of focus on yield and only yield. Buildings with deferred capex requirements that were 20, 30 years old were trading at 2-3% cap rates because they were able to finance at zero. And the incremental buyer was someone who wanted to capture that spread. They were completely asset insensitive, they're quality insensitive, they're looking at these vehicles as bond plus proxies. And now, when you look at all the deals that were done in the last couple of years, they start looking silly because the interest rates are going higher and there's no internal growth at the property level. So I think for a lot of asset classes, I think for us as a world, coming off the zero bound, we're going to break some stuff. In the US, we just got that hike again, and maybe we'll hike again in September. We're going to break some stuff, unfortunately. It was so difficult to listen to Powell's, Q&A, and again, I don't think he's a dumb individual, but what he wants to say, what he knows is coming, and the way he has to thread the needle on every single damn question, it's tiresome.
Yeah.
And already we've pivoted away from Japan, but Ryan, I want to let you take a stab at it. Your thoughts, what impact it has in your corner of the world.
Yeah, well, we're real quick, and then let's go. Yeah, go to Ryan if he has anything to add. That'd be awesome. Just to tie it in, I mean, I think like you did a great job of tying it back into the real asset implication. I want to make sure we touch on that because it's like, okay, what are these guys talking about? Like Twitter, I was like real assets, like yeah, but this has massive implications on real assets. Real assets, whether we're talking about, let's look at these. Your guys to, specialties, right? So energy companies, right, is something that Ryan's a landman. He's very familiar with these energy companies. He writes them up on Seeking Alpha all the time. Jimmy, former REIT analyst, knows real estate very well. Low interest rate, ZERP, right? Real estate loves ZERP. Energy companies hate ZERP, but, generally speaking, right? I guess. Higher for longer, if you will, if commodity prices and interest rates stay higher for longer, that's great for energy companies, horrible for real estate. Would you think that's fair, Ryan?
Yeah, I do think that's at least, in terms of cross asset allocation, you probably have a pretty good divergence between the two there. Of course, nothing's linear, and there's going to be times like just the way the dollar sort of tends to trade inversely to, let's say, oil. You get periods in time where the dollar and the oil actually correlate. Like, coming out of 2001, it was pretty interesting because the dollar was rocketing higher,
right?
Which is, my under my just sort of base understanding is a little bit more of like a, I don't know, we'll call it a margin call on outstanding dollar denominated debt outside of the system, which is kind of why we see these big spikes in the US dollar when we have sort of crisis and things like that. But, in a general sense, yeah, I mean, the dollar, interest rates, all those things sort of create a feedback loop that reverberates through the energy complex in important ways, and you know, it's everything from, you know, the petrodollar, for better or for worse, although it's been challenged now, you know, with a lot of crude being settled in different, um, being settled in different, like a lot of it's being settled in in the yuan, or like, local currencies here and there. But for the most part, the petrodollar system's still pretty much king. And um, it's one of these things that, you know, we can afford high oil prices when we've got this deflationary backdrop and yields are low, and there's money, there's kind of rent seeking money out there who was willing to finance a lot of these domestic oil producers. But you start to get into a rate environment like this, and it doesn't make a lot of sense for these guys to take on debt um, to grow production when their shareholder base is saying, no, we don't want to grow production. We want to live within our means. We want to live within our cash flow. Well, that's a long-term feedback loop that is going to deprive the world of the necessary amount of supply we're going to need. So, we already had one little shock coming out of COVID. I would attribute that more to an epic dead cat bounce, for one, and also just a acute realization that, like, well, it was a lot of factors. Like we said, multifactorial. It's tough because the Russian invasion of Ukraine, that there was a convergence trade between European energy and our energy. But really, it comes down to the fact that we're getting to a point now where we just don't have the reserves or the excess reserve capacity, and we're not spending money, especially with these rates, to keep up with supply. And I look at energy as more or less a building block of the economy. And it's one of those things that, we're going to have a tough time maintaining interest rates, not only from our own government's financing perspective, but also incentivizing domestic energy companies to, continue to produce at the levels we've become accustomed to over the past 10 years. And, expensive energy is a problem in a rising interest rate environment where you cannot paper it over by, having QE policies that keep the demand up.
No doubt. No, I think that's
You
very
make
well
so many
said.
good points there, Ryan. Yeah.
Yeah. And like, you can't print energy, you can't print barrels of oil, right? And so to your point, there's a lot of different, we're talking about the BOJ, different ways of BOJ, FOMC, central banks around the world. It's like there is different ways they're putting their hands on the scale, or feet on, whatever the saying is, feet on the scale. And energy could be where that those these disequilibriums manifest. That could be almost like that could create problems in energy prices, right? I think is part of that.
There's
Yeah,
one thing
Jimmy,
I wanted to touch,
please.
there's one thing I wanted to touch on that Ryan said that I think makes a lot of sense. And we started this segment by saying how energy and real estate are a little bit different.
Yeah.
But then when I look over a longer time frame, especially on the cost of capital and on the capital allocation, there are a lot of similarities between these two sectors.
Right.
The cost of equity capital has been challenged for many years now. In the energy space, we know that there's been a lot of ESG backlash. There's a lot of there are a lot of structural factors that send signals to companies that they have to be leaner and that they are not going to get that type of external shareholder capital to grow, even if it makes sense economically to do so, right? The cost of equity was punished so much, even in a low interest rate environment. And now we're going to a higher interest rate environment where, again, you would think higher prices spur incremental capex, especially in shale where you can get it off the ground pretty quickly. But when debt costs are rising and the equity cost of capital is not strong enough, it's going to suppress new supply. In real estate, you think with zero interest rates that the market would do well, and lo and behold, they hit all-time highs at the time globally. But now in the last couple of years, really, if the pandemic catalyzed some of these larger questions around use case utilization, in a lot of sectors, you have secular impairment about the function of that real estate. And for a sector that is so dependent on debt, just like energy is, it's so dependent on cost of capital as a means to finance, and as a means to transact properties, they're frozen. The real estate market today for commercial real estate, outside of small time deals that can be done in all cash, effectively is frozen. You can't get to the debt market. Certainly for variable debt, forget about it. For longer term debt, the 10 years been resilient, but what are these companies doing? They're not developing. They're not, other than the home builders, they're not acquiring new assets. They don't have a great cost of capital. And we're going to have to just go through this. This is not a quick fix that resolves itself in the next 6 to 12 months, right? Some of the energy dynamics are also more medium term in nature. They're not going to resolve themselves if the Fed magically goes back to zero. There's a lot of things that have been broken, and they need to work themselves out.
Yeah, no, I think COVID, we talk about it a lot, but probably not enough, how much COVID reshaped our lives and our views on personal residential real estate and having a home office and how important that is. And, on the opposite end, of course, is going to the regular office and getting, obviously getting employees back to the office has been a massive struggle for these companies. Coming up on various time limits, we all got stuff to do. You guys are busy guys. I wanted to, maybe let's do this. Jimmy, I know you got to jump off at 55. So maybe I want to give the floor to you and just say, okay, talk to me about, I'm gonna ask you two questions. One is specific on office, but this is a common pattern. This is called the stairways to death pattern. But then we've got this, not a CMT, by the way. No, all technical patterns are not not intellectual property of me. You got the stairway to death pattern mixed with the stairway to heaven pattern. Just like this week on week rippage of office. Has anything changed? Is this part of the meme stock trade? And then the second part of that is anything in earnings you saw last week that you think was, you want to call out real quick, and then we'll get you out of here and we'll talk to you soon. And thanks for your time.
Yeah, man, happy to take some of that. We're still relatively early in the earnings season for real estate. A lot of the companies are yet to report. This week was a busy week for a lot of the bigger companies in these big indices. There's so much focus on AI and all that hot air. Again, it's even if it's something for people to get excited about. From a revenue standpoint, they're still relatively de minimis. I thought this one quote kind of encapsulates everything. So, Microsoft CEO Satya Nadella, great spokesperson, super smart guy. But if he is emblematic of this AI bubble, this is his line from the presser. Organizations are asking not only how, but how fast they can apply this next generation of AI to address the biggest opportunities and challenges they face safely and responsibly. We remain focused on leading the new AI platform shift. I mean, you hit all the keywords for the consultants. And, it's when you're talking these big ideas and the market's enamored by them, I think it's reflective of a certain market psyche. I'm not going to say it's a bull market. We talked about this right before the recording. The S&P is at 52-week highs and 8% of the index is at that level. It shows you kind of the dynamic of where the capital has gone to, and perhaps a commentary on the sustainability of said rally. But in the real estate space, we continue to get incrementally bearish prints on the value of certain asset classes. Class A office in Manhattan has dropped by X, it's still very much conjecture. You know, we've talked about not a lot of transactions happening. And, you know, when I listen to the earnings calls, and I make a focus to listen and not read the transcript. You know, one of the biggest things that I learned very early on is you got to hear the tone. You got to hear the tone to see if they're upbeat, if they're robotic. And then, depending on how far you want to dig in, you want to hear the type of questions that the analysts are asking. You know, are they giving them softballs and layups? Are they pressing on a specific pain point? Are they trying to tease out implied guidance in the back half? You know, the second quarter earning is big like that because, again, real estate, you're collecting rent most of the time. It's not a very volatile sector from an earnings perspective, but every bit of same store growth helps. Every bit of internal what have you helps. So by the second quarter, it's put up or shut up. You know, if you're not raising your guidance, you're saying something about the business trajectory of that year. And if you lower guidance for the year, it's kind of shot. You know, it's a bit of a wash, right? What is the from an incremental catalyst? What is the thing that kind of spurs a back half recovery, which is hard to find in most property sectors in the way that the companies are constructed. So it tends to get, in my opinion, maybe over scrutinized by the dedicated real estate players. But if you're more of a 30,000 foot investor and you're looking at the sector and you're looking at the trends, we're still very much in a period where the macro dominates. And it's not about what companies are doing at the asset level. There are definitely times in this cycle where their ability to add value, their ability to operate is appreciated and reflected in the relative valuation differences. But really right now across all real estate, you know, if I can get 5.5% risk-free in the bank and I have to deploy $100 million, $200 million, $300 million, what is the rush? What am I getting by taking on 7% debt and buying an asset for 6 cap? You know, it's like the math doesn't work. It's just the math right now. And that's why the markets are frozen. That's why there's no property transactions. That's why these companies are not getting love, because after their G&A load, after their debt burden, after capital expenditures, you know, what is the actual unlevered cash on cash return of these businesses? It's lower than the risk-free rate. And that's
Right.
that's the, you know.
Wow.
That's doesn't seem super appealing when you put it that way.
That's powerful.
Pill to swallow, right? Because
It's
we
a
love
hard
real
pill.
estate. And it doesn't mean it doesn't do well over the years. It doesn't mean that a particular property can't double, right? It's real estate is block by block. But these larger forces are really something else.
No kidding. Yeah. Jimmy, really appreciate your time today. If you just pop off whenever you got to go.
Yeah. Great to meet you, Ryan. We're going to have to keep doing this,
Hey,
right?
Yeah.
Yeah,
Get some
absolutely,
value add
Jimmy.
in oil and
Thank you.
gas. We'll have to talk
Yeah.
shop.
Yeah.
Thank
We
you so
call
much
it.
for
Yeah.
uh,
No, sorry to cut
his
you off, Ryan.
perspective on
No,
that.
we call it Real Assets Weekly. We haven't been doing them weekly, but we should. So, well, put that in your pipe. We'll see you hopefully next Friday, Jimmy, if you're around. We'll take it offline. But that sounds fun. Yeah, Ryan. The stage is yours. So, Ryan, I know you've been busy. I know you just moved and stuff, so no stress. But I wanted to ask you. Yeah, I wanted to ask you. Similar big picture stuff. So, just in general, bunch of companies you look at, or not, I shouldn't say a bunch, but some reported earnings even today, Exxon and stuff. Curious if you had any thoughts on that, any thoughts on setups, life in general. The floor is yours. Great to see you.
I think the best service I can provide is to sort of try to assimilate my analysis into what Jimmy just said, because full disclosure, I haven't read or listened to Exxon or Chevron's earnings calls yet to see. But when you talk about mood and you talk about, the way the way the C-suite in these companies talks about their asset base, their future, their business, you can kind of garner a lot from that. And it's been kind of hilarious because, oil companies in general are pretty demure when they give their, earnings calls. But at least, Exxon, Darren Woods, excuse me, he's been sort of thumbing his nose at analysts and the government and people lately. And I think part of that kind of it's kind of hilarious to me, and it was something I was working on this thread on Twitter to explain. I haven't really got around to making a point yet, but I'll try to make it succinct. And I was calling it what was I calling it? The difference between a rock and a stone. And so
Okay.
yeah, what this means here is that um, you know, going into COVID was this sort of perfect storm of deflation. You have a macro event. You've got this ESG is just, it's like peak ESG. They're the marching bands out there, they're almost declaring victory. And one of the, chief proponents behind it is Larry Fink, of course, who runs, BlackRock.
Yep.
And you know, then Exxon gets removed from the Dow, and it's almost like this contrarian bottom happened. And then all of a sudden, it explodes out of there. And it's just it's very hilarious to me because just the other day, Larry Fink named hold on, let me find this real quick.
No, I'm so glad you're talking about this because I listened to the to Exxon and the walk, and just on the walk to work this morning, and that was one of my big questions is like, how much time do these guys it's like it's Sanjay, it's the Microsoft AI thing. It's like you gotta just spend all this time and energy talking about emissions and climate change and the ESG stuff. It's funny.
Yeah,
And it's like that. You
it
think this
is.
is like
And
asking big tobacco about, what are you guys doing for? Like, I just, it's funny that they spend a lot of time talking about it.
yeah, well, a couple of weeks ago, here's a quote from Larry Fink. I'm not
Yeah.
going to use the word ESG because it's been misused by the far left and the far right. So
Yeah.
he's abandoning the ESG term.
Good
And
first
then
step.
just last week, he goes and announces that um, uh, they are hiring the Saudi Aramco boss, Amin Nasir, to be the fund's independent director, being BlackRock's independent director for that region. I mean,
Excellent.
how ironic is that? You've got like honestly like one of the biggest faces of the carbon business, and prior to this, you're intentionally destroying value in these companies, and now you're having to walk all that back and actually hiring the Saudi Aramco CEO as a advisor to your fund. And the even more hilarious part about that, and why I'm kind of getting back to Darren Woods thumbing his nose at everybody, is that Exxon has quietly been investing in carbon capture, which they think is going to be a bigger part of their business, or at least compete with their hydrocarbon producing business in the next 20-30 years. And they went and bought Denbury. The chief reason for buying Denbury is because Denbury has like the biggest like CO2 transportation and pipeline system across all the sort of important basins. And this accelerates Exxon's ability to develop their carbon capture across the meaningful areas where they can kind of move and store these things. And, the beauty of that is what we call it's called the 45Q carbon capture tax credit. And it's been around for a while, and it was kind of de minimis, but it was actually Biden has changed it to where it's like, it's more or less, it's I don't know, it's tripled from what it was, and there's ability for it to grow. So not only is Exxon now arguably the leader in doing something that actually has a substantial impact on climate change, they are now reaping the benefits of government tax credits to do so. And I just think it's such a hilarious and ironic twist of fate, from where we've been over the past 4 years. And
That is so funny. Yeah.
it kind of underscores the point that these big producers, they get it. They have their own scientists that work on on the climate change issues, and for the most part, they're not in disagreement. They've had to settle in certain cases, but they also have the scale, the ability, the capital, and the technical knowledge to find solutions to these sorts of things. So for the most part, I think the majority of climate related mitigation and success is going to come from the fossil fuel industry. And that is not, something you hear very often.
So say that I felt like I was with you until the very last sentence. You think that say that last line again if you don't mind.
Just I think the majority of climate mitigation strategies that are going to actually be effective. Let's not just qualify it as like everything, because there's going to be a million different ways this is looked at. But
right.
The ones that are going to not only be effective for the goal of reducing carbon, but are also going to be the most commercial, are going to come from the fossil fuel industry.
Got it. No, now that totally makes sense. So and this is fascinating. Like, I really think that the carbon capture stuff is really interesting. It's way above my pay. I don't really understand it, but I think it's an interesting thread to be pulling on. My very limited understanding is that part of what Buffett sees in Oxy, or part of his thesis for getting so involved in Oxy, is their market leading carbon capture business. And something like, I want to say the stat was something like Occidental today has a 50+% market share in carbon capture, but they see it going to less. They see the TAM is so big that it's going to be a fast growing business for them, and they're going to end up with 1% market share or something like that, like some tiny single digit. So
that's and just to kind of clarify here,
please do.
Oxy does have one of I think with this recent transaction, Exxon's probably going to wind up being have a little bit more market share there.
Okay.
Oxy is banking on a different type of carbon capture.
Okay.
The way I understand it, they're basically gigantic fans, like the size of a tennis court, and they sequester the carbon into these things, and they blend it with potassium hydroxide or something like that, and it binds the CO2 and kind of creates these salt pellets. And then the pellets can actually be used again for, not exactly sure what they're going to use it for, but it's a pretty interesting process. It's something that not only sequesters carbon from the air, but produces some sort of reusable commodity, supposedly. And it's been highly touted, and if it works correctly, could be a blockbuster. And I guess Buffett's on board with it because he's willing to back it. He could have easily been out of this trade by now, and he's not. And so he must be a believer in it. But I do think there's some unanswered questions about whether this technology will work, as opposed to like what Exxon's strategy is, which is just more like sequestration at the source and then pipelined into underground storage. I guess if you really wanted to dig into the two, maybe there's some kind of pair trade there, whether or not you want to back Oxy or you want to back Exxon there, but for the most part, it's a little bit early, I think, for Oxy's strategy to really know. But it's something I am 100% keeping an eye on.
Dude, I think that little explainer was super interesting. And I think that we can I think we could do a whole episode on all kinds of carbon capture stuff. I think it's fascinating. Part of the reason is that like you had mentioned, it's and for those maybe to really state it out, I think everyone kind of gets this, but it's like with carbon capture, all this you wouldn't have, the idea is if you could you wouldn't have to worry about so much prevention if you had a cure, right? You wouldn't have to worry as much.
Sure.
So, that's why it's such an exciting for people worried about climate change. Carbon capture is a fast moving technology, and like Ryan said, the solutions are very likely to come from our current fossil fuel industry.
Yeah. I think all of this is to say that I think the mood is sort of changing here around oil and gas, all the negative connotation, and it's still going to be there. I've been watching videos of people getting drug out of the streets in Europe for blocking traffic because they it's like, we don't need oil. And there's a bunch of people and there's a bunch of angry motorists literally dragging these people out of the streets. They're like, we got to get to work, man. Come on. So it's I think, we have to understand the world we live in. And I think the financial community is sort of dropping the woke facade and kind of coming back around to the fact that not only do we need oil and gas, but we need all above energy strategy, that's going to underpin a relatively weak economic backdrop. Because if we don't have cheap and reliable sources of energy, we're going to have a very hard time, maintaining the economic growth that's going to be needed to fix a lot of these issues, and but it's a double-edged sword, right? Because if we don't invest and we cannot really resolve this kind of sticky inflation, or the government's not willing to walk back interest rates, which does appear like they're probably going to here soon. But, let's say we get stuck around 4 to 5% on the 10-year, well, all of a sudden, you're not going to have financing for oil and gas. The Saudis have already admitted they don't have spare capacity. Biden's already pilfered the SPR as a buffer to this. There's some factors that I think in the near term are going to work against oil, but it's the most critical, that and real estate are most critical components of the what the Fed looks like in terms of inflation monitoring. And there's kind of this scenario where Powell declares victory and all this, interest rates maybe normalize around, I don't know, we'll call it 3% on the 10-year or something like that. And they say we've defeated inflation. Well, here comes 2024 and oil soars back over $100 again. Well, what do you do now? You look like a fool, because now you're either going to have to, resume fighting inflation through interest rates, or you're going to have to admit that you got the story wrong. And that's the kind of eye of the needle, I think, that Jimmy's referring to. And why you're seeing Powell so perturbed answering these questions is because he's stuck in a catch-22 here, and he knows it, but he can't admit it.
Right. No, they've exceeded my expectations for sure for handling this. I'm surprised. Like Jimmy had mentioned, that I believe what Jimmy said, they will raise until something breaks. People have said that for a long time. Just because they've raised for 14, 15 months now, and they've gotten it this high and nothing's happened. Am I surprised by that? Absolutely. Have I lost conviction that it's not even that something's going to break, although that seems very likely, but it's more that will they probably, will they look silly at the end of this? I think it's almost inevitable, right? I think there's just, it's such a tricky thing they're trying to pull off. They've had a lot of success so far, but they've had a lot of tailwinds. And I think that it's almost inevitable. They're going to look as silly as BlackRock talking about ESG, or, it's not ESG, and then putting the freaking Saudi Aramco guy on the board. Like that's, not only is it something, not only are we combining one of the world's greatest fossil fuel emitters, but they're also, human rights tragedies that would violate, would take the E, or excuse me, the S. So you've got the E, and then you have the S, and probably there's plenty of G violations as well. So no wonder he doesn't want to call it ESG anymore, because it's just such an obvious. So you
can't make this stuff up.
You can't make this stuff up, man. And it's so perfect that it's so cool. Like I really do think that dichotomy of energy and real estate, they really are, like you had said, I use this quote all the time, but Eric Basmagian, great young economist on Twitter, real estate is the economy, and energy prices flow through into everything. And so I like that there's this, the higher for longer kind of pair trade, if you will, that it's like, benefits one at the expense of the other, and then vice versa. And I think the idea here is, let's close on this. There's one more thing I want to touch on. Let's got to get the daily email plugged here. So this, this broadcast is sponsored by Swami Research. Take the free Swami Daily ETF report for a spin. Go to swamiresearch.com, sign up today, and you'll get all of this for free. We've got 250 tickers, sectors, factors, fixed income ETFs, mostly focused on ETFs, but within these lenses, right? Within energy and within REITs, we take a zoomed in approach, right? We want to look at specific real estate investment trusts in different sectors. We want to look at specific energy companies across different sectors. We've got some the ETN notes, which, by the way, we don't necessarily recommend anybody buy or sell, like USO, UNG, UG. Those notes are tricky, but they're good canaries to watch. And then mostly what you see here is tickers, right? These are mostly companies. And so last thing here is we could just touch on any setups or anything, don't need to say too much, but the whole point of the Swami daily ETF report is like it's purely quantitative, right? So it's not, you don't have to read research, and again, this works really well quantum mentally, right? Bottom up, top down. Bottom up is you have to really know your stuff, man, and a guy like Ryan does, but it takes a long time. Top down, it's we're using data, and we're using these price and price volume and volatility also is a component in the Swami score. And the Swami score is a strength of signal that goes from -100 to +100. And basically what you're seeing here is we also give you levels, right, to buy and sell. The range, percent range, just means like where is it in the trading range. A high number means it's overbought, generally speaking, or in the high end of its trading range, and a low number means it's generally towards the low end of its trading range, or it's oversold. But also, as people that have been following this stuff for a while know, markets that are going up tend to be towards the high end of their trading range, vice versa. So blah blah blah. Within energy, we've seen this recent strengthening across the board, while at the same time we've seen fixed income, not just price wise, but also Swami score or strength of signal wise, really take a turn south. Commodities, kind of a mixed bag, but the net energy based commodities starting to look good. So blah blah blah. Ryan, any thoughts here on the strengthening within these energy names?
Yeah, so we kind of broke out of this little channel we've been in, which is kind of interesting to me, at least for most of the names on the daily charts. I'm running through our energy universe here, just kind of looking at the Swami scores, they're relatively, high. We see our little BSM trade here holding pretty steady with a nice
That's been
run
great.
there.
That's been money. Check
Little
out that.
little plug there.
Yeah, that was a great call, man.
Yeah.
Thank you. The Turtle Family Office thanks you for that one. That's been
Thanks. Yeah, we'll get more on that when I get this research piece done too. But I think there's a few things. It's hard to call the immediate term direction here. It does look like, we're sort of making a push, that 80 level. We're sitting right there at that 80 level on the current contract. We need to take that out with volume if we're going to have an immediate run here. I still tend to think that there's probably a pullback in the entire equity sector coming up. I think a lot of the performance of the energy names is somewhat linked to just the relative strength of the overall market. So I'm not really sure that it's breaking out on its own merits here. So like have we made a double top on the spot? Where are we at here on the S&P? We're not quite to a double top, but it looks like we'll probably at least challenge that high in the S&P from very late 2021.
right.
I mean, just based on price action. So say we end up with some kind of double top, and then we get some, we get sort of the lagging recessionary effects a lot of people have predicted, and we have another sell-off or something, which I see as a fairly likely outcome, but I'm not going to make that prediction.
Right.
But I think that you could see oil trade back down into the 60s or 70s. What's interesting to me though is like we're still like if you look on a contractual basis, like time spreads or the futures curve for oil, we're still in a period of backwardation, meaning that prices are lower on the further out month than they are on the front month spot prices. And that's typically a indication that the market needs supply now. And you tend to have the best performance in oil and oil related equities during times of backwardation, as opposed to contango, where prices are higher in the later months. And so that has never really broken down. And I think that is the supply side equation telling the market that higher prices are going to be needed. Now, we've got a lot of macro factors that can hold that down in the interim. So I'm not real bullish on it just yet, and I'm not real sure on the timing, but I would think within the next 9 to 12 months, I do expect a pretty big run up again in oil. And maybe it makes sense to kind of start dipping your toes here. Chevron looks like a pretty interesting trade for me. We're just kind of pinging this trend line. We can, somewhere around 156.90 is where I would be looking, with maybe like a 1 month time frame to around 167, 168. So from a short-term intermediate trade, that's something I'm kind of interested in right now. Other than that, I think it's still a little bit of a wait and see. It belongs in your portfolio. We've talked about this. It gives you some diversification against other things.
Yeah.
Kind of using, again, I'm using our models. I'm using our quant guys to manage this stuff, and I'm not really allocating a ton of money just yet. I'm stuff like BSM where I've got a good yield in some of the bigger, I'm managing that because, the yield's fantastic and it provides a little margin of error on things.
What about
one thing I'm looking?
Please
Oh,
go
sorry,
ahead.
go ahead.
No. You go ahead. I was gonna ask you about
one
Natty.
thing.
Let's get a Natty outlook for you before we go. But jump into what you're gonna say.
Oh yeah, just one thing I think I underestimated and has pushed my time frame back a little bit on the was, the China reopening. I don't want to say it was a flop, but it wasn't what everybody expected. And everybody was pointing to how much crude they were buying, as they're buying all this crude, and
Right.
everybody took that as a sign that demand was going to be really robust. Well, really what China was doing was filling up their strategic petroleum reserves as cheap as they could. And most of that oil is still being stored over there. It's not being used. And so China's going to be selling into the market if prices get higher. And that might be one thing that could kind of suppress it, alongside another little interesting tidbit that Russia and China have bought up most of these super tankers, where they own like 80% of the super tanker fleet now. And they're sort of perfecting these trade routes where they're turning off the ship's monitoring deal. So a lot of the Russian crude and Iranian crude and stuff that's not supposed to be on the market is actually on the market. So it's a little murky to me from the supply side, like where we stand internationally. But Valero came out the other day and said they think the DOE is underestimating gasoline demand by a pretty large margin. Like they said, their internal numbers are up 14% year over year. And, going back 3 years, they see gasoline demand in their internal calculation like 27% higher than it was 2 years ago. So, unfortunately, the quality of data that we use to predict a lot of macro factors in the oil and gas is suspect sometimes. So all of that is just say I don't have a very strong conviction in this space for the next probably through the end of the year. I'll put it that way.
Beautiful, beautiful. No, very well said. I think that that makes a lot of sense. I think that the color on the China Russia thing is fascinating. I think as a generalist guy that just tries to listen to things and just try to pay attention, the fact that the Russian crudes finding a home, not shocked. That that is fascinating, and I wonder, and I think that's a really interesting the ship, the giant super tankers, that is really interesting. So tell me, before we let you go here, and thanks so much for your time today, this has been fun. What about
Absolutely.
Let's close on natural gas. What any specific thoughts that are different? Maybe what you just said for oil, I assume mostly applies to gas, but maybe where are the differences? Is there anything specifically to call out? Like if Europe, I think the Europe winter, right, is kind of like maybe the main a big theme that natty gas trades on. Is that fair? And do we have to keep an eye on that still? Because remember last year was supposed to be this cold winter for Europe. And go ahead.
Yeah, man, that's what makes natural gas so tough. The shape of the structure of the curve is never very reliable. It's so weather dependent. Like they always say, you got to be a meteorologist if you want to be a natural gas trader. And I don't have a lot of conviction. Obviously, Europe never really solved these issues, although a lot of them, Germany, a lot of these places have gone back to burning coal, burning wood for electricity. They're importing high sulfur oil and actually burning oil at a negative operating cost just to keep people's homes heated and things like that. So, I mean, if the government can subsidize that expensive form of energy, they may avert another winter of natural gas prices, especially if we don't have cold weather over there. But, if they have some intensely cold winter and we do too, then we're probably going to be in the same scenario we were last year, Right. And it's just very hard to predict. One thing you may look at is some kind of like long natty strategy, probably not using UNG, like we said, because of the the roll decay, maybe one of the stronger pure natural gas players that has some LNG. EQT comes to mind. They've got some problems with their balance sheet, but on top of being the largest producer in the Northeast, they've kind of got an integrated service and LNG business. I'm looking into them a little bit more. I guess the idea would be to sort of be long American producers with the ability to export, and then maybe short European industrials that are very energy intensive businesses. It's very hard to find a pure way to play this trade. So that's kind of what I'm thinking, but it's not something I've really hammered out quite yet.
Beautiful. Well said. And no, that makes sense. And I think, again, for anybody that didn't watch Ryan and I chewing the fat on BSM, I think that was Real Assets Weekly number 9. That was a great, number 8, excuse me. So 3 episodes back. Find it on the YouTube channel. That was great. Color on that. And I think that one thing I got from that is the way I'm playing it, and maybe I wouldn't feel so great about it had the share price gone the opposite way so far, but it's like oil, energy prices in general, it seems like almost like call option is strong, but it seems like with a balance sheet that has no debt like BSM, and they have they're a low cost producer, we're just a call option on energy prices in general. I don't have to think about too much oil versus gas, etc. You think that's fair?
Yeah, I mean that's kind of it's a fence sitting way of getting around it here, but I mean in general I'm just kind of market action across many equity sectors is a little tough to reconcile right now, and I just I'm happy to be maybe a little under allocated. Like Jimmy said, it's kind of hard not to just stick your cash in short-term treasuries. And so, I'm still a little bit on the sidelines. I'm watching. I've got some ideas. I'm looking to, we talked on our last episode. My thought process is to come up with my best idea and try to sit there and poke holes in it. And I've got a few that I liked, was able to poke some holes in. I've got a few that so far have been relatively bulletproof. So a little bit more about getting the timing right and not doing the Larry Fink fools rush in type maneuver here, and then having to walk it back.
Yeah.
But I think this should historically be a pretty strong time for oil and gas, and the fact that we're still not really breaking through this trading range, and the Saudis have been trying to jawbone it and do whatever they can, cutting production. I think the market is still trading around the concept of demand and the possibility of a recession until we get some resolution either way there. I think it's hard to really want to put a lot of money to work here.
No, it's such a you can tell that's when I listen to the guys on spaces that are talking about Tesla will triple in 2023, they don't sound as measured as you do. I don't know. It's kind of funny. It's weird. Versus a guy like you, where you have your family, your livelihood is tied to these commodity prices. I'm sure it's probably good for you if commodity prices go up, generally speaking. But it's like you have this, you can take a nuanced approach, and it's not about just trying to convince our viewership here that it's the world's going to look this way in the future. It's very hard to say.
Yeah, and it's tough for me, right? Because like when I talk about the family, the family office and managing money, I have to divorce myself from my actual career doing this, because I have career risk invested in the oil and gas space, meaning like commodity price fluctuations affect my livelihood.
Right.
And, so on a personal level, like my PA, I don't feel the need to be as aggressive in this space because I've already got enough career risk invested in it. For them, it's more about the right allocation, and it's not the career risk is not a factor in that.
Yeah.
If that makes any sense.
No, it does. And also, I mean, for them, I mean, if them is the guys on Spaces, for them, it's like they're talking to you about a highly correlated asset, or in general, most of this stuff's all correlated, right? AI, it's like, hey, it's it fell off the blockchain, right? Like it's the same, it's all, if you look at correlations, it's all it's all the same thing, right? Or many things trades with NASDAQ, right? Cryptocurrencies, AI stocks, they trade with NASDAQ. Energy prices do not. They are an entirely different thing. And getting off of zero, as the Bitcoin guys say, I was like, where have I heard that line? Getting off of zero. It's the Bitcoin guys, I think, that say that. And so
okay,
you need to get off of zero with XLE. No, you don't need to do anything, but getting off of zero with XLE might be the move here. I don't know, you do you, but that's my move for sure. And I think that and so one last thing that just to touch on, and I don't know if Ryan had any comments, but another big oil company that reported this week was Shell. And I didn't listen to the call. I listened to a couple minutes of it. It just gets kind of funny. It's like these cheeky British guys, like just kind of get a kick out how they do the Q&A is funny over there. Yeah. But this is the highest scoring Swami score. So we got a nice high Swami score. Swami score has been increasing a little bit, and it's the highest score on the page. We're low end of the trading range. So basically, here's how I would use this. Last thing on here is like the trend line is at 58 and a quarter, 58.23, 58 and a quarter. And the stock's at 60 today. It's high 60s. Or I mean, excuse me. It's just below 61 is what I meant to say. And highs, it's below 61. And it's right at its PWL. It's pre-Wu Flu level. TM Dr. Jin on Twitter. But it's right where it came into Twitter. Into COVID. And so, yeah, just point being, it looks like an interesting place to take a poke. You could definitely draw a trend line there if you were a CMT. Yeah. But above, like I said, 58 and a quarter is the trend line. And so if you do get long, that's a good, a little below that is, we like drawing trend lines or lines in general with Sharpies, not fine tooth pencils. I think it's a good place to maybe set a stop loss, and potentially it's something to take a poke at. Any thoughts there?
Yeah. Well, it's made since the blow off top in crude prices back in June of 22, it's made a higher high, which is pretty impressive because most of these stocks haven't.
Right.
I got it on my charting program. I'm just kind of looking.
Yeah.
It's got a Bollinger Bands show some pretty massive volatility in it. And there's definitely been, which could be a good thing or a bad thing,
Right.
You've got a bunch of, high volume nodes kind of in this 58 to 62 level. I think if you can get it back down around 58, it's kind of same with Chevron, it's got a couple points to fall before I'd like to pull the trigger, but it looks like a pretty good trade, really. That last little poke prior to August, making that new high, cancels out the old bear trap formation, or the bull trap formation, where you had a high and then it didn't quite make another high. So yeah, it with the volatility being that way, maybe some kind of I don't know, maybe sell a put around $58, and maybe it gets put to you here on the short term, and then try to own it for the next leg up or something like that. I don't know. It's kind of interesting.
Ladies and gentlemen, one of the most interesting men on Fintwit, according to me, Ryan Cobb. It's been a pleasure. No, and I mean that. Check out it. And I think his Fintwit's cool. His Instagram is better if you can find that. That's where the real juice is.
That's my stunt. It's my stunt double.
This guy is a man of many talents, and well, cool, man. Thanks so much for coming on. It's been a lot of fun. I think that's a good place to wrap it for today. And
awesome, you're too kind, my friend.
Yeah,
good talk with you, Turtle.
Yeah, absolutely.
It's been a heck of a ride, man, and we'll keep it up.
Party's just getting started. Best yet to come for Swami Research. Like and subscribe, and we will hopefully, if we get around to it, we'll see you next week. I think we probably will. We'll probably see you next week.
Yeah, I'm around. I'm settled in.
Good deal.
I've done enough adventures for a while, man. I'm in the office here for a bit. I got to catch up. All right, brother. Have a great weekend, man. We appreciate it.
Likewise.
All right.